Good evening, everybody. Welcome to our YouTube channel, Fast CPA and Consultants. I'd like to introduce our CPA, Fulton Abraham Sanchez. Welcome, Fulton.
Thank you, Sarah.
If you're visiting us for the first time, you send us your questions via email, DMs, private messages, and then we group them. And then we'll do a tax talk series, which today's topic is auditing. So are we ready to begin with our questions, Fulton?
Yes.
Okay, awesome. First question, why should audits be done and how often is an audit recommended?
Okay. Many times an audit is a requirement when a company has financing from a bank or from a group of private investors. The audit report is required, or it is a requirement that the company is compromised or compromises or promises to the bank or to the private funders, to the private investors, that a financial report will be delivered at the end of the fiscal year. This requirement is a compromise between the company and the lender, with the only objective of certify the healthiness and the soundness of the company in question. The audit report is the summary of an independent accountant, an independent certified public accountant, of the examination done through the accounts and transactions of the company in a particular year. This is what is called the financial audit, the actual audit of the books of the company. In addition of doing an audit because a bank requires, there's also even when there is no financial obligation, meaning that there's no funding from the bank, there are, for example, hedge funds, there are equity funds, there are all the public companies require an audit report, and small companies require that, for example, when there is a process for selling out the company. When the company is being sold, company is in the process of being purchased by another party, usually the other party requires an audit report. So why is done and why is recommended? It is done. First of all, we only do audit reports when they are needed. And the need, or when it is recommended to do an audit report, is when usually there is a bank loan, when there is, for example, a company selling $100 million, they have a line of credit of $50 or $75 million, the bank will require a audit report. At that point, it's not a recommendation. At that point, it's an obligation. Now, when there are multiple partners in a company and none of them works in the company, it is recommended that the company goes through an audit report. Because one thing is that there are 5 partners, 6 partners, 7 partners in a company of 5 shareholders, 6 shareholders in a company, and the 5 of them work in the company, so everyone has an idea or at least know what is going on in the company. But if none of them work in the company, and there is a manager or a CEO working in the company, and none of the partners and other shareholders are working in the company, they only know the financial statement of the company, but they don't know the operation, they don't work within the operation of the company, it is recommended that the company takes or goes through a process of auditing every year to provide a report to these non-participants or not working partners or shareholders in the company. So that is the key moment when an audit is recommended. It is also recommended when there is a process of purchasing the company. Then external auditors will come to give an idea of the actual state of the finances of the company through an independent audit report.
Awesome. So second question, what processes are carried out in an audit?
the process that go that an audit requires are based on the scope of the audit. If the scope of the audit is a full audit report, then the first step that goes into the audit is the planification, was to create a plan for addressing the particular areas of the financial statements that will go on a specific review. So the first step, like any strategy, is to create a plan. That's called the audit plan. In this audit plan will be a distribution of the hours that each of the activities, each of the reviews in a particular account will be given, and what areas of the company and the financial statements of the company will need a more in-depth review, like a deeper review, and that will obviously create a larger number of hours for that purpose. In addition, there is also in this audit plan the human resources that will be needed to comply with the requirement of the review and investigation as per the number of hours that have been planned before. So it's basically a report of activities, a report of time, and a report of human resources needed for the execution and the distribution or the delivery of the actual audit report. This is the plan. Once this plan is created, then it goes to the second step or the second phase, that is the execution of the plan. In this plan, it's not in the execution. We're not going to say in the execution we're going to review X or Y account. It is in the plan. The plan says what are the particulars of the account that needs to be reviewed, and in the execution we only follow the plan. Many times, remember that if we have hours and we have human resources in the plan, we will have cost, and that's how cost is allocated for the client. So if there are issues that have not been revealed or issues that are encountered during the process of the execution, then the auditors usually go back to the plan and increase the number of hours, but that will be more cost for the client. So it is a good idea that the moment that the audit plan is created and there is a questionnaire, a lot of questions for the client that are given for the client to answer, and then those answers go by the account, it's good to have a good relationship between the client and the auditor to have all the answers correctly and in deep. So the auditor doesn't have to go back to the plan and increase the number of hours that will take effect in the cost of the actual process of audit. Once there is in the execution phase or step, the auditors will have to find what is called a range or a ratio of tolerance for errors. So let's say that there is no 100% auditing unless we audit every single line, every single transaction of the financial statements one by one. It will only be possible 100% ratio of non-errors, but that doesn't exist yet. There is an advance in terms of artificial intelligence, and that's something that we are applying. Artificial intelligence is able now with a software to review all the transactions. It's able to review because software are now very parametric. They have specific parameters that when we use the artificial intelligence software, these parameters are able to be used to detect the errors automatically. But remember, we are detecting millions of transactions. We are reviewing millions of transactions through our software, through artificial intelligence, and it is possible now to do 100% review, like having 100% assurance of errors. Now it is possible. In the past, no. In the past, we have to create a range of 95%, 96%, usually preferable 95%. And in that, with that ratio of the transactions that we used to review, we didn't review all the transactions. We select a block of transactions to review. That will be the sample. Okay, we select a population, and within that population, we will do the review, and that will have to give us a 95% ratio of assurance, meaning that anything above above 95%, that's fine, but it cannot come below 95%, because if it is 95%, we have to do more work, and that will be costly for the client, because it will be more hours. So the idea before is to establish what is called a coefficient or a percentage of acceptance of error for the transactions. And then we apply analytical procedures, meaning that at the analysis of analytical procedures, doing all the procedures as we do the transactions. It is there where all the mistakes are discovered. And if those mistakes are listed, and at the end, those mistakes are given to the client to be fixed. And then next year, the client has to prove that they have been given. Otherwise, we will not be able to issue, we'll have to review them again to issue an opinion, because the objective of the accounting report, the auditing report, is the issuance of your opinion. It's my opinion that the financial statements are correct. They do not present the number of errors that will compromise the materiality of the company. So this process, at the end, once the analytical procedures are created, are performed, then the accountant, the CPA, is satisfied with the examination, and that satisfaction will provide an opinion, and that opinion is the report. That is the process. Anything start with a plan, then the execution, and finally the giving of the report.
Okay, great. So third question, what team of professionals participate in the audit process?
Okay. It all starts with management. Remember that, and this goes by any industry. This could be a hedge fund, could be an equity fund, it could be a real estate, it could be a cryptocurrency company, it could be a public company, manufacturing business. Any single business starts, any single audit starts with management. Management is responsible for the transaction, and management is responsible for providing the financial statements approved by management. Management will have to approve the financial statements and give us a official, let's say, official formal financial statement, like financial statements of the company. And based on that, we will do the examination. So at that point is the first participants of the audit process is management, the management of the company. If the company has an audit committee, many public companies are under the obligation to have an audit committee. Like this committee is in charge of the process of auditing, and is the committee that deals with the auditors and the audit report. It's not management. If there is an audit committee, this audit committee will be in contact with the auditors and will coordinate the audit with management. So first one is management. If there is an audit committee, it will be an audit committee. If there is no audit committee, it will be only management. If there is a board of directors, then it will also, the board of directors will participate in the process. And say small, medium-sized companies like hedge funds, equity funds, and small companies, medium-sized companies, real estate companies, manufacturing companies will deal with the management will deal with the actual audit. If there is a board of directors in many equity funds, hedge funds, there is a board of directors that also participate in the process. So it will be then management, and it could be an audit committee or the board of directors, and then Also, the attorney of the company will be involved. The attorney needs to provide to the certified public accountant, to the auditing firm, that there are no legal lawsuits that will compromise the existence of the company in the future, because the audit report will have to give a part of the opinion if there is an ongoing concern. Ongoing concern is the ability of the company to survive in the next year, because remember, the report is for the year before, but then there's an obligation now, or a requirement from the generally accepted accounting standard, the GAAP, accounting principles, the GAAP, that and also the Financial Accounting Standard Board, that the auditor in a public audit needs to give an opinion about the ongoing concern of the company. So the management needs to provide a letter, the attorney needs to provide a letter, and that letter is to not to prove, but to confirm that there are no lawsuits that will compromise the ability of the company to function in the future. So it will be management, it will be an audit committee. If there's an audit committee, it will be the board of directors, if there is a board of directors. It will be also the attorney. The attorney, either the company is large or small, an attorney needs to be involved in the audit for the provision of this legal letter that is required for the opinion. Without that letter, then no opinion is given at the audit, and the audit report will not be given.
And last question we have: what requirements a company must have when conducting an audit?
The first requirement is the financial statements. A company needs to produce the financial statements, and those statements cannot be done by the auditors. Otherwise, independence will be compromised. That is the first requirement for an auditor to produce a report, is independence. So without independence, the auditor cannot provide an audit report. So the first requirement is a set of financial statements, balance sheet, profit and loss, and cash flow. A set of financial statements to provide those financial statements to the auditors. That is the first requirement. Second requirement is the provision of a management letter. Management letter is the one that I said before, is the affirmation of the responsibility of management, that all transactions have responsibility of management. That is the affirmation that management does and signs. This could be a CEO or the president of the company that is signing. Also, the attorney needs to provide a letter confirming that this I said before, the attorney needs to provide a letter that there is no legal lawsuits that will compromise the ability of the company to function in the future. Once all these elements are given, all these papers or these documents are given, is when the auditor is able to provide with the examination. Within the examination, there is questionnaires. There is a list of questions that the auditors give as the audit process goes. If there is, for example, accounts receivable that need to be confirmed, the auditor also needs to send independent confirmations. For the banks, the auditors need to confirm the bank directly with the banks. Before it used to be letters. Now, in the USA, there is a system to verify, but perhaps not immediately, but you do it online. You can do the verification of the bank balances with the banks, not with the client anymore. Before, in the past, the auditor has a format for a letter. Sign the letter and give it to the client, for the client give it to the bank, because the auditor doesn't have a relationship with the bank. But that in many cases, those are cases for books. Fraud was committed, and then accounts and balances were forged, the reports. So in the US, it's saying 2000, like quite a few years ago, was implemented the ability to verify bank balances directly with the bank. So only you enter to that application, then the client needs to verify that you are the auditor of the company, and then once the client verifies, then the bank sends directly in the system, in the online, sends directly the verification of the balances. So there is no need to, in the future, to verify. So this goes with the verification of the financial statement before the production of the report. Then goes the verification with the vendors if there are accounts payable. If we are dealing with banks, for example, then that will be verification with specific clients. If there are loans, for example, then loans verified with specific clients as well. So it's a process of verification, and verification for balances, receivables and credit and payable, and also verification of the actual balances of the account, the transactions. So once all these elements are covered, then it comes the draft report, and that draft report is the one step before the actual report. So all these requirements, there are formal requirements like the financial statement. There are management requirements like the letter from the management confirming the responsibility for the financial statements. There is a letter from the attorneys confirming that there is no legal lawsuits for that creates a danger for the company working in the future, what is called ongoing concern. And then comes the verification of the banking of the balances of the bank, that is directly with the banks, verification of the account payables and account receivable, verification of investment, verification of loans, verification of balances, investment, for example, investment in the stock market, investment in bonds, investments in general. And then at the end, it comes the report with all the recommendations and the explanations that is required. But those are the requirements that a company will need to comply for let's say for obtaining for an auditor to provide the audit report at the end of the year. This also requires physical verification. For example, when there is fixed assets need to be verified physically, and review what is the classification of the entity for the administration of the fixed asset. If there is any lease, if there is any kind of management system that the entity will provide for the review and the organization of the fixed asset. If not, then the auditor will review the transactions and the purchases of fixed assets with the physical assets that are required. This involves many times visiting several offices if the company has several offices, or going to the physical places where the assets are located. We think of assets like computers, machines, but what about, for example, turbines, like large steel plants where assets are in the hundreds of millions of dollars, probably in the billions of dollars? What about like the eolic turbines, for example, like those large fixed assets that create energy? What about there are, for example, utilities, those are utilities, the ones that provide electricity, power, the ones that provide water, pipelines. All those are fixed asset, large fixed asset investments that require an exhaustive and very well knowledge of the valuation of the existence of those large investment assets.
Awesome. So that was all of the questions we had for today. Thank you, Fulton, for your time. Thank you all for listening. If you have any questions, you can send them to our emails, private DMs on Facebook. You could reach us at a private group we have. We'll place the link below in the description box. And that's all. Thank you, and keep in touch for the next video.
Thank you.